Hi, welcome. This is Mary Ellen McGonigal, Senior Managing Director of Stocks here at Simpler Trading, with your weekly Edge show for Saturday, March 26th. Let's take a look at what we'll be covering today. First up, we will take a very close look at the broader markets. Where did we close the week? Last week, we did reveal to you that the markets had reversed their downtrend, so we'll see if we were able to continue beyond that. Also, take a look at some of the more impactful news that drove price action last week. As usual, we will also take a very good look at the underlying sectors and industry groups in the markets. We want to see where that relative outperformance is, all with an eye toward helping you prepare so that you can outperform the markets as well. Viewer question of the week, and this week it's all about select ETFs that can again help you capitalize on some of this strength that is taking place and is anticipated to remain in place. So you'll want to see that as well. So let's go ahead and take a look at some of the more impactful news last week that did in fact move the markets. Early in the week, we did see a very high inflation report from the UK, and that in turn trickled over to the US markets. We did start the week on a down note. However, we were able to recover, as you'll see. Oil prices were on the rise last week, a lot of that having to do with crude inventory dropping. The impact from that was pretty monumental. We'll get into that. Also, jobless claims, they dropped to their lowest level since 1969. This is a weekly report that comes out. A lot of that due to the fact that there is a dearth or a lack of possible employees. So employers are not letting their employees go. But unfortunately, in turn, there will be wage price pressures that will continue to keep inflation high, which is also the impact with oil prices increasing. Durable goods order and consumer sentiment both fell last week, and that is all about, for instance, consumer sentiment is dropping due to the very high inflation that we are experiencing, particularly as it relates to oil prices. Just going to the gas pump will confirm that. And then durable goods order is unfortunately could be a sign of the economy slowing down. It was the lowest number in about 5 months. So we will keep an eye on that. 1 month certainly is not a trend, but it is something that we don't necessarily want to see. And then up next week is going to be critical inflation data will be released, as well as the employment numbers for the month of March, all providing more clues as it relates to that high inflation, and then the Federal Reserve's potential response to that. So from here, let's go ahead. We'll take a look at the broader markets and see where we closed the week. And this is a daily price chart of the S&P 500 and a couple of dynamics taking place here. Last week, if you haven't seen it already, you can take a look. We did identify that the downtrend in the markets had reversed. Very positive news there as the index closed the week above this 50-day simple moving average. The good news is we have continued on with that rally to the point where we are now above this longer term blue 200-day simple moving average. So very constructive price action there. Your outside momentum indicators, your RSI and the faster moving stochastics are both above 50. So they're in positive territory and conceivably heading north. And one last factor that is taking place, and that is the shorter term, this green 10-day, the purple 21-day simple moving average are both trending upward. And this is very constructive. When you have these shorter term moving averages cross the longer term, that's known as a golden cross. But more importantly, as these moving averages advance, they can then become support during an uptrending period. So we can go back following this pullback last fall. When these moving averages moved upward, they were acting as upside support indicative of a continuation of the current uptrend that's taking place. So from here, I'd like to share with you a view of those 11 sectors in the S&P 500. This is a 2-month daily price chart view, and I've added this RSI. That's a relative strength indicator, sorted it in descending order. And what's taking place here is that your relative outperformers, your strength is positioned up here, and then down on the lower right quartile are your weaker, certainly relatively weaker. Here's your S&P to the broader markets. So let's take a look. Utilities up here in the forefront, all about the higher yielding stocks faring well as inflation hedge, and utilities are now at a new high. The other dynamic here is these utility companies have been able to pass on increased rates to their customers, which is going to positively impact their continuation as it relates to growth. Also, materials stocks up here in the forefront. This particular industry group was up almost 4%. We can see this really sharp rally. A lot of that is also inflation related. A number of these metal stocks are ideal inflationary hedges, and then also underlying scarcity versus demand dynamics. And we will get more into that as well. Up here in the forefront, of course, energy. I mentioned oil stocks back up on the move, almost $120 per barrel, but energy back in play after this pullback, so poised to break out to a new high. Of course, these increased oil prices are very bullish for the growth prospects for oil stocks. And industrials up here at the forefront. This particular group did not outperform this week. It was up 1.1% relative to the S&P, up 1.5%. However, very bullish looking chart, just similar to the S&P 500, back above that 200-day. And as we move forward, I'll share with you one area and an ETF that can capitalize on this move back into industrials. From here, let's go ahead and take a look at some of the underlying industry groups, even drilling down further beyond the sectors. Again, that 2-month daily price chart view. And again, strength to weakness. So up here at the forefront, we did see a very big uptick in Treasury yields. This is the yield on that 10-year Treasury. Very significant advance for the week. A couple of factors here. Number one is as investors embrace the stock market further, they will sell their bonds, which in turn causes the yields to increase. But also the Federal Reserve is beginning their rate hike cycle, and that in turn is pushing up these yields higher. Next up, we can take a look. I mentioned to you Brent crude oil on the rise, not quite up at that 140 spike that took place when Russia first invaded Ukraine, but certainly on the move higher with your outside momentum indicators trending upward, which again is good for energy stocks, but not so much for consumers and inflationary pressures. From here, we can take a look at other areas that are decreasing or decelerating, and similar to last week, this is the volatility index or fear. The VIX is now dropped down to this 21 level. Very constructive. If we can get that VIX down to this 18 level, that is a much more normalized area, and then we can continue to gain traction with the broader markets. One area that turned positive, I identified this in my MEM Edge report last week as potentially turning positive, and it did so. We were able to add NVDA to our list, which had a great week. We can see that this semiconductor ETF has broken back above all of its moving averages. Your RSI now trending upward, and that MACD up here in positive territory as well. And then last up, we can just take a quick peek here at these software stock that is in the throes of potentially reversing this downtrend. We had a nice spike rally from these lows here into this area. However, they do appear to be stalling. A major software company did come out with earnings last week. They were not great because the management guided lower for this year, and that did have an impact on the group. We're keeping a close eye on that. So that's a view of the broader markets. And from here, we'll take a look at some of those ETFs that I mentioned that are positioned to continue to really outperform the broader markets. And first up is a smaller ETF. It's Van Eck Rare Earth Strategic Metals, REMX. And you can see it had a nice run up this week. However, the momentum indicators are not in overbought position. They are trending upward, the RSI above 50, and the stochastics, we had that nice black line up through the red signal trending upward. So from here, I will share with you the fact that this particular ETF offers a nice 5% yield. And of interest to me is to take a look at some of the bigger names in the group. MP Materials is one of the heavier weighted names in this particular ETF. So from here, I did mention the ability for you to use ETFs so that you can participate in that move into industrials. And one of the more vibrant areas among that industrial sector are defense and aerospace stocks. And a good ETF there is ITA. It's the Aerospace and Defense ETF. So we can see the ETF has hit a new high in price. And once these particular areas, whether it's stocks or ETFs, really get going, I like to add a 5-day simple moving average so that you can help define a potential buy point on a pullback to that 5-day simple moving average, which right now is at 111.8, so a point away. And while the stock has had, or the ETF had a nice move this week, we can see the RSI is not quite overbought, still further potential upside here as globally defense spending is increasing in light of Russia's invasion of Ukraine. Let's take a look at a couple of the heavyweights in this ETF. RTX is Raytheon. Another one is Lockheed Martin, LMT. And you can see both of these stocks had big run-ups after the initial invasion of Ukraine, have pulled back and are now in nice confirmed uptrend. On Lockheed Martin, look for this black line up through the red to signal a confirmation of this new uptrend. Both stocks are large cap. They do provide aerospace and defense products globally, and we are seeing an increase in budgets for that. Last up on that ETF front, I talked about high yield stocks being a good defense against inflation. Sharing with you here DVY, which is the Select Dividend ETF, and these are higher yielding stocks. You can see that it has broken out of this nice base this week. Again, your momentum indicators still have further upside here. This particular ETF does provide a 2.9% yield. From here, I'll share with you two of the heavier weighted names in this ETF. This is Oneok, OKE. The company provides a 5.2% yield. It is a oil pipeline stock. And then Philip Morris is also a top holder in that DVY ETF. And we can see this gap up here. This particular company has a 6.7% yield. And again, a heavyweight in that ETF. I'm going to leave it there. Everyone, have a great weekend. I look forward to seeing you here next week. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.